Okay, so in this video, I'm doing session 5 to 6. This is the second last video of part 1 and part 2. Now, going into part 2, we're doing session 5. So, a depository institution. So, when you think of depository institution, always think about banks, right? Depository institutions are people or places that holds money, right? So, they act as like your bank where you put your money, or they can give out loans. Basically, they store the money in the economy, right? So their job, depository institution, they are like a business, right? What they do is they take deposits from people. So when people have extra money, they'll put them in the bank, and the bank will take this money and give it to other people, and the other people will have been charged interest for the bank, so they create profit for the depository institution. Now, profit and prudence. So the whole concept, the way banks make money, is they get money from us, the people. They give us a small interest rate, but they lend it to people as loans at a very very high interest rate. So at the end of the day, the income they get from loans is more than what we get from the interest rate income. So therefore, the banks make money. Now, depository institutions, they provide services, right? So they provide like how your credit cards, when you tap your card, when you swipe your card, those things, transactions, fees, all those online banking, they are in charge of it, right? Now they earn most of the income by funds received from depositors to make loans and to buy securities that earn a high interest rate and pay to depositors. So yeah, as I was saying, they earn more money from the loans, the interest charge in the loans, than what they pay for us to get deposited our money. So depository institutions, right? They do four things, A bank receives from deposit funds that borrow into four types of assets. Okay, so the money that goes into bank, when we give the money to the bank to keep, but what do they do to this money? There's four things they can do. A bank reserves. Now, what are bank reserves? So when we give money to the bank has to hold this money. I mean, we're giving them to the bank. You might be thinking, how are they holding all this money? What the bank does, it holds a certain portion of their money as reserves. So if you can picture a movie, and in the movie has a big safe and all the money is there in a bank, that's what a reserve is, right? So as a percentage money of it receives have to be put in a big safe, which call a reserve. Liquid assets. So they'll buy assets that can be easily converted into cash, right? Treasury bills are like, how can I it's like basically it's like an asset, right? You buy this treasury bill, and then in a month's time you can sell it off for a higher price. Investments are like bonds, they're long term, right? So if you want to buy a bond like you pay R1 million, and then if you sell it 1 year later, it worth 1.5 million. That's a bond. Loans, the bank can lend out the money, which they do, your money, to loans to other people. Now, economic benefits provided. So, what are the advantages of depository institution? It creates liquidity. So, if I want my money from my bank, I just have to get it, right? It's easy for me to get the money, liquidity. Pool risk. Now, the money which you give the bank is given or is lent out to other people, right? But the pool risk is very very low in banks. Why? It's because let's say we have 1,000 people and your money is given to those 1,000 people. If one person from 1,000 doesn't pay, it's not that big of a deal. So it's low pool risk, right? Lower the cost of borrowing. If you have to borrow money from the bank has to lend out money to you. It won't be that expensive. Then rather going to a loan shark or people that lend you money. Lower the cost of monitoring borrowers, so you don't have to like worry people that if they don't pay you back when you loan out money, then the bank will do the business for you, right? How depository institutions are regulated. So banks and all that have to be regulated. They can't do things on their own, right? So deposit institutions required to hold a levels of reserve, ratio. So all these things, these rules, what banks need to do. You may ask, who actually is in charge of this? It's called the South African Reserve Bank, central bank. So the central bank is a bank of banks, meaning the central bank under it has all our banks. Central bank is the most important bank. It's a king bank, right? A king is in charge. The central bank, which is the South African Reserve Bank, SRAB, they basically monitor the banks, tell them, listen, you need to hold this required of ratios of money, you need to require this amount of money, you need to do the interest rate dash. You need to. They'll basically make all the rules, right? So it's a public company. It has a majority shareholder as a government, and yeah, it has a minimum of 15 members, right? Parliament. The Reserve Bank's goal and targets, right? So it's conduct monetary policy. Monetary policy are like rules and regulations which banks must follow. It adjusts the money quantity of money in circulation. So the if you picture the Reserve Bank as a person who like creates money, they will like be in charge of how much money for them to be put into the economy and so on, right? So it's a responsibility to formulate and implement rules, issue banknotes and coins, supervise banking sectors, ensuring effectiveness functioning in the payment system, act as a banker for the government, right? Sometimes it can also lend money to the banks. Now it's very, very important. I'll tell you this: the Reserve Bank's policy tools. How many? You say it's three. So there's three policy tools, right? Or regulations that it creates. The Reserve Bank. Number one, the required reserve ratios. Now you might be thinking, what's a reserve ratio? The formula to calculate reserve ratio is the reserves that the bank holds over the deposits which the bank has from the customers. Yeah, that's how you do it, right? Reserve ratios. All deposit interests are required to hold a minimum something percent of deposits as reserves, right? So all the money they get as deposits, obviously we give them the money that's deposits. They have to hold this money, certain portion of it, in the reserves in the safe, right? That is how you calculate it, right? The amount of money in the reserves over the deposits, right? Repo rates. Now, what is a repo rate, you may ask? The South African Reserve Bank, they give out money to banks as loans. It's so funny, but yeah, they give banks money, loans. So, obviously, when they give out this money as loans, they need to charge interest rate to the banks. So, that's a repo rate, right? Open market operations. So, sometimes the South African Reserve Bank will sell things to banks, right? It'll sell like bonds and all that to banks, and banks will buy those bonds from them, right? So basically, Reserve Bank sells things to banks, which is so like funny, but yeah. Um, the Reserve Bank policy tools. So the Reserve Bank buys securities from commercial bank. So what this means? So that when the Reserve Bank, right, buys things from our bank, the Reserve Bank puts money into our economy. The commercial bank is like our ordinary banks, right? They're part of our economy. So in the Reserve Bank, which is the creator, which is the king, puts money in the commercial bank. Because remember, when it buys securities, it's buying from this bank. So obviously it's going to give the money to this bank. So if our commercial banks in the economy get money from the Reserve Bank, the supply increases of money, see? But if the Reserve Bank sells securities to commercial bank, if the Reserve Bank sells something to commercial bank, that means the commercial bank buys it from the Reserve Bank. So the commercial bank, all the money from the Reserve Bank goes to the Reserve Bank. I mean, all the money from the commercial bank goes to the Reserve. So now there's money less in our economy, right? So this will house. Yes, basically it will decrease the supply of money, right? Obviously the reserves will also be reduced, right? Now, when the central bank wants interest rates to be higher, it sells off securities. So, the reason how this works, right? When they sell securities, our banks will pay money to them. Because now our banks have less money in their keeping or in their safes, they will charge a higher interest rate, right? Because there's less money in the economy. Remember, when there's less money in the economy, interest rate goes up. If there's a lot of money in the economy, interest rate goes down. It makes total sense, this, right? So demand and supply of money. So you know how we get the demand and supply curve? We get it with money also, right? The quantity of money demanded is the amount of money that people want in their hand. This is very important. So literal cash on their hand or coins is the money that people plan to hold at any given day, right? Demand of money. So the influences of money holding. So what like increases the people who need money versus decrease people who need money? So when the price level goes up, people need more money. What is price level? Is the average price of goods and services, right? of certain goods and services. So when that goes up, you obviously need more money in your hand. Nominal interest rate. Nominal interest rate is interest rate without inflation. You get the real interest rate, which is adjusted for inflation. So when the interest rate goes up, right, this means that people will get more money if they put their money that they got in their hand in banks. So let's say if I got 100 and sitting with me at cash, if I put that in a bank and the interest rate is very high in the bank, that means I'll have less money. So my demand for money will decrease, right? Because all my money I'm putting in the bank because I'm getting interest on it. So money in hand is less. That's why quantitative demand will decrease. Real GDP. When real GDP goes up, people will buy more things, produce more stuff, so everything increase. So quantitative demand increase. Financial innovation. So obviously when banks become more technological, so like you can do EFTs, you can easily put money in the banks, the demand decrease, right? You can easily put money in the bank now. The demand of money. So the demand curve of money, obviously demand curves are always like this. Now you might be thinking, why the shape? So can you see this is the interest rate y-axis, this is the real money. So when the interest rate goes down, people will hold more money. Can you see? When it goes down, people hold more money. When the interest rate goes up, people put more money in the bank instead of holding the money. So that means people need less money, right? Less money demanded. Now interest rate, right? Any change in interest rate moves along, right? Moves along the curve. But anything besides interest rate, like example, real GDP increases, price level increase, this whole demand curve will move. So increase will be like this, right? So if it increases, it'll go like this. If it decreases, it'll go like that. Shift in the demand curve. So as I said, a decrease in real GDP decreases the demand, increase in real GDP increases demand. So you can see same thing I drew. Okay, so yeah, the quantity of money that can be created by banks depends on the monetary base. Monetary base is all the money in circulation in the economy. So desired reserve ratio formula. It's the reserves the bank has over the deposits the bank has, right? The way you remember this, desired reserves. So as soon as you see reserve, that's the numerator. So reserves over deposits, right? That will give a ratio. So if the bank has 1 million in reserves and it has 1 billion in deposits, so you'll say 1 million over 1 billion, right? And then you get a ratio. Currency drain ratio. As soon as you see currency drain, look at C and look at D. C is the currency drain ratio. So it's a currency over deposits. So currency drain ratio is currency over deposits. I'm just checking now, 1 second, if what I said is correct, because I don't want it to be wrong. Currency drain ratio is in currency held in the bank over the total bank deposits. Currency over, yeah, I'm right. Okay, so an increase in the interest rate over here implies an increase in the opportunity cost of the reserve. Okay, so let's say if the interest rate goes up, right? Now we're looking at the bank's perspective. What happens to the reserve ratio, or what happens to the reserve? If the interest rate goes up, then the bank, it will be better for the bank to take out the money from the reserves and put it into the economy, loan it out to people, because then it can get more money, right? So this means the reserves will decrease, because the reserves are like the bank, right? If the interest rate is going up, banks lend out more money because they can get more money. So they'll take out the money from the safes and put it in the people, give people. Banks lend out greater percentage of their deposits and their desired ratio decreases 100%, right? Now the supply of money curve is a okay, so it's positive, it's going up, right? So the way you interpret is interest rate, okay. So supply of money, think of banks. So when the interest rate goes up, the bank will put more money in the economy. It'll lend out more money to people, so giving people more money. So that's why as it goes up, see how it goes to the right, it goes up, it goes to the right also, see? So it increases, huh? An increase in interest rate causes an upward slope. So anything change in interest, right, it just moves from like this dot to this dot to this dot. But if actual supply increases or decreases, for example, if it increases, it'll go like this. If it decreases, it'll go like this. Yeah, as you can see over here, right? So a decrease in monetary base has nothing to do with interest rates. So a decrease in monetary base actually affects it. It decreases the supply, the actual supply, right? And obviously you can see it affects it. For example, if they ask you in multiple choice, what happens when you move along or the supply changes? Right? So you see how this supply, this blue one here, changes and goes to this. So you can clearly see over here that the interest rate is increasing. See? So you can interpret it like that. The money market is where you get the demand for money and the supply of money in one graph. Now if there's a shortage of money, now demand. The demand is us people. The supply is the bank. So if us people want more money, right? That means there's a shortage of money. If the bank only has R1,000,000 but people want 2,000,000, there's a shortage of money. So what happens is the interest rate goes up. When the interest rate goes up, this bank over here, this graph, will go move. It'll move over here to the center. It'll be perfect. If we on top of here the supply, so if banks have more money than people want, what's going to happen? The interest rate is going to go down. So banks will stop lending out money to people because the interest rate is too less. So they'll go down, and meet at the point, right? The market equilibrium. So obviously this is called the market equilibrium. This is the quantity market equilibrium. This is the price interest rate equilibrium, right? Yeah, so I discussed all this, right? Surplus of money will be over here. Surplus. A shortage will be over here in the bottom. Surplus is up, shortage is down, if you need to remember it, right? Okay, now this whole long run thing, people get very, very confused. Very confused, this whole long run equilibrium and all that. So when the inflation rate equals the expected inflation rate and real GDP equals the potential GDP, the market and all these things are in long run equilibrium. When you think of long run equilibrium or dealing with this money thing, think of good. So what long run means? So I want to use a business example. Now short run business. Short run business, you open up a business, it's short run, right? You don't know how to handle your customers, you don't know how to do things right, you mess up certain things, right? But you learn, right? As time goes on and you move from short to long run time period. So right now you're doing all stupid stuff, you don't know how to operate a business, but as you're moving along to long run, time is moving, you're getting good. So over here you know your mistakes, you're not making those mistakes more. You increase your customers are getting good, business are going better, you increase, you're getting more sales, you're buying more products, you're getting more businesses, and basically when you arrive at long run, this is a period of a long time. So because of here you were stupid and like you just doesn't know how to operate a business, your whole economy over here is stupid, it's bad. But because here now in the long run you made so many mistakes, you have experience, you'll be good over here in the long run. So that's how an economy works, right? So when the interest rate goes up, the inflation rate goes down, we have recessions, all that. All that is in the short run. But as we move to the long run, people become aware that listen, your interest rate is going up, we need to save money. This goes down, we have to save money. Economists make decisions more better. We learn from how the economy is operating. Therefore, in the long run, we actually know or predict the economy and like basically we're good in the long run. So therefore, expected means real GDP inflation rate means expected. So we expected inflation rate of 2% and we actually achieved that 2%. It means that's perfect, we're doing good. So in the long run, everyone is happy, everyone is good, right? So that's how I must think of long run. Now, this quantity theory of money, again, people don't get it, but it's very, very easy, right? If I give you okay, so how do I make this simple? Now, just for clarification, MV is same as this. Now you might be thinking what I'm saying. MV is equal to P. Why, yeah. This is simple maths, yeah. If I make P the subject, wait, where's P? Oh wait, this is P. If I make P the subject, MV over Y is equal to P. That's how they get you this, right? This brackets is same MV times over Y. Now what this means, right? I want you to look at this. M is the quantity of money, V is the velocity, Now, you might be thinking, what is velocity? If I give you a 10 Rand note, that 10 Rand note went through so many transactions. If you get a 10 Rand note and if you buy or give it to a business, that business will take it, give it to another person, that person takes it to another person. Each time it goes through that process of a transaction. That's your V, velocity. Price level is obviously the average level of prices in the economy. Real GDP is Y. Okay. Now, you might be thinking, well, how this thing works. Okay. V is constant and Y is constant. So I'm just going to scratch it out. Now, I might think what I mean by constant. That doesn't change. So to me now, this equation, it cancels out because like it doesn't change. It's independent. I mean, it's deep. It's independent. It doesn't change. But what does change in this equation is M and P. M is the supply of money. P is the price level. So the price level is like the prices of goods, right, in our economy. Now, what this whole equation is trying to say, when the supply of money or when the people put more money, this increases, right? But because this is equal to this also has to increase. So that means P is increasing. So when M is increasing, P is increasing. When M is decreasing, P is decreasing. So whatever happens to M happens to P in the same proportion. So this is why, this is exactly your 5-year-old question. Why can't we have unlimited money? If the government says, let's give everyone a million rand. If you give everyone a million rand, that money is going to go up plus. But also, the prices of goods are going to increase. So if let's say bread now is 20 rand, if the government give all of us a million rand, the price of bread will increase from 20 rand to 100,000 rand. And I'm not joking, that will happen according to this formula. So you see, so you can't. Unlimited money is impossible. There we go. This whole theory is busted with unlimited money. If you put more money in the economy, prices of goods will increase. That's just things. So, because when you were a child, you thought when you have unlimited money or when people give you unlimited money, you're going to buy that good the same price. Why do you think in today's time, like long time ago, you should earn like 100 rand and the prices of goods were cheap, but now you're earning about 10,000 rand, but the price of good increase. So when more money comes in the economy, it goes up. So proportional increase, right? So I discussed these 3 tools. Okay, I discussed all this, right? Multiple choice. These are the questions you will get. The South African Reserve Bank, also known as SARB. There we go. A. I don't have to look in the other ones, right? It uses 3 main policy tools to control the quantity of money supplied by commercial banks, right? So it's like 3 rules. I suppose economy is initially on the demand D1. What is the effect increase in real GDP? Increase in real GDP. Everything's increasing. More goods are being produced. People want to buy more. So obviously, the demand of money. People want more money in their pockets. So it obviously will be this graph. So let's see. MD2. Now where's MD2? The demand of money itself will be to MD2. If SRB wished to increase the supply of money, they could. Let's see. They could reduce the ratio, reserve ratio, because if you picture it right, the bank, and let's say us people, the bank over here has all its money in the reserves. So if SARB is the South African Reserve Bank, this person over here is the king. He's in charge of this bank. So if the SRB wishes to decrease the supply of money, that means decrease the supply of money to people, it'll increase. It'll tell the banks, listen here, have a less reserve. So that means the banks have to give out more money to people. So it's A. But also it'll be decrease the repo rate. The repo rate is the interest rate the SRB lends out to banks. If it decreases the repo rate, banks will want to get more money from SRB as a loan because they don't have to pay more for the loan. So therefore, when they get this money, the money flows to the bank and then flows to the people. Increase. Which of the following represents the equation of exchange? Hold on, this may be another math trick. MP, oh no, it won't be, because this is MV over here. So it's A. And that's it.